You're trying to get away from some of these companies that have been big tech players and maybe gone up a little too fast. How do you do that?
Well, you use the tried and true principle of diversification. I think a lot of investors are not aware that if they're in the S&P 500, they're in the triple Qs or in the XLK, the prominent tech ETF, they own Apple and Microsoft and other big names, and they're massively overweighted. Look, in the XLK, Apple and Microsoft are over 42% of that allegedly diversified tech ETF. So what we want to do is offer that same comfort of diversification, get away from the Mag 7 and use more of an equal weight approach. And we do that using the JP Morgan Tech Leaders ETF. First Trust has a NASDAQ 100, more of an equal weight ETF. And this way we get exposure to the great industry of our time, the one that's not only great within itself, but making tech-enabled companies great. And we allow it to have a slightly less risk profile and move away from the Mag 7.
How strong a gut do you have to do that, though? Because there's this Russell 2000 problem where things that aren't big just really haven't been performing well, especially when there are interest rate concerns.
Well, that's a great point. These are also large, prominent companies. They're names we know. They're just not small and emerging technology. They're established tech companies that may be a little bit more overlooked. But on that small cap trade, gosh, if this economy keeps going the way it's going, and if the Fed has to sit on the sidelines because the economy is doing this well, that typically is a good environment for small cap. And we think that small cap core, small cap growth side would be a little better for that because we are a little concerned about small value and their exposure to community banks.
Speaking of community banks, how do you view that and the regional bank issues as we look across multifamily and we look across office and see some spots of trouble?
Well, we are concerned about small and community banks. There's a couple of reasons. One is a massive structural disadvantage they have in the cost of deposit gathering. If you talk to bank presidents, they acknowledge that an internet-based bank or a behemoth like a Bank of America or a JP Morgan have at least a 100 basis point, if not 150 basis point advantage in gathering deposits. And that will crush a gross margin, a profit margin, when your cost of goods sold goes up. And I think that's pretty simple. People forget about it in banks, but that's how bank profits start. We also think the real estate exposure is a bit of a bubble. Banks have been putting it off, restructuring quietly. And we think, again, small and mid-sized banks will face the bigger brunt of that pain.